Alright, ladies and gentlemen, so today I wanted to give y'all a overview over modules 17, 18, and 19 in your Krugman's AP macro book. Module 17, 18, and 19 introduce the aggregate model and sort of go into detail about it. Module 17, we're going to start by looking at aggregate demand by itself. Module 18, we're going to look at the short run and long run aggregate supply curve. And finally on module 19, we're going to put it all together and we'll see, honestly, the most important graph that we're going to do in this class. Okay, the aggregate model each year consistently will be 1/3 or more of your AP exam. Okay, so mastery of this graph is of the utmost importance. And so, as we're going through this, make sure you're taking your notes, make sure that you're paying attention, and as you guys get questions, make sure that you send me emails and or come into tutoring. We'll go over those together. Okay. So the first thing we're going to do is we're going to start with module 17, and we're talking about aggregate demand. Okay. And so what I want you to do on the side of your notes, okay, on the side of your notes, I want you to go ahead and write down the word aggregate. All right. We've talked about this briefly before in class, but this word right here, aggregate, means total. Okay. When we're talking about aggregate demand in economics, we're talking about all of the demand for the entire country. Okay, so whenever we're saying aggregate demand, we mean the entirety of the demand that every single consumer, governments, everybody within our country has. All right, so just like the word gross, when we were talking about gross domestic product meant total, aggregate also means total as well. Okay, so we're talking about aggregate demand, we're talking about total demand for the entire country. So let's go ahead and take a look. So aggregate demand, or AD for short, shows the amount of real GDP that the private, public, and foreign sector collectively desire to purchase at each possible price level. So just like regular demand, the relationship between price level, or price, which we're measuring on the y-axis, and level of output, real GDP, we're measuring on the x-axis, is going to be inverse. All right, so if you'll go ahead and take a look on slide 4, you've got a picture of what the aggregate demand curve looks like. All right, now one thing I want to point out for y'all that's a little bit different than what we did before. All right, over here on the y-axis, we're now using PL, price level. All right, price level is going to refer to the total of prices within the economy. Now this is different than when we were looking at just price previously with regular supply and demand. So we're looking at cumulative or total price levels within the entirety of the nation. Okay. The other thing I want to point out is instead of measuring quantity, we're measuring the quantity of all final goods and services produced within a nation in a given year's time, but specifically in real terms. Okay. Going back to, earlier, whenever we're talking about R, okay, we're talking about real. Fix that E. We're talking about real. Okay, real meaning we're taking into the account the effects of inflation. All right, so real GDP, we're talking about taking into account the effects of inflation within the economy. Okay, I'm going to go ahead and fix my real fast. Sorry for the bad joke. But we're talking about real GDP, so we're looking at GDP with a fixed dollar. Okay, we're indexing. So think back to when we talked about CPI and inflation. We talked about having an index year. Remember that index or that base year value is always going to be 100. So whenever we're looking at real GDP, we're looking at how the U.S. economy has grown from a starting point to where we are now today. Okay? So there's a couple things that cause aggregate demand to shift, and what makes it really easy for you is when we're focusing on this, we're going to look at changes in consumer spending, gross private investment, government spending, and or net exports. So in other words, and I'd write this down on slide 5, we're looking at the determinants of GDP. All right? So the same 4 things that affect GDP also affect aggregate demand. And so what makes it nice for students when you're going through this is there's not a big guessing game, because if one of these things change, aggregate demand is going to change. There's nothing else. Okay? So if consumer spending, businesses, private investments, the amount of spending by the government, and or the amount of our net exports or our exports minus our imports changes, then we're going to have a change in aggregate demand. Now, I've got up there about the multiplier effect. We are going to talk about multipliers in here, but basically what we see is that a change in spending actually causes a greater change in the economy than just the initial change itself. Okay, so that's just a little note for you for right now. We're going to come back to that in more detail. I want to talk to y'all about both the spending and the tax multipliers and how they can either increase or decrease the size of our country. All right, but just like every other graph we've done, increases always go to the right, decreases will always go to the left. All right, so on slide 6, we've got an example of what an increase in aggregate demand would look like. Okay, we would go through, we would put our label on the y-axis for price level, x-axis for GDPR, downward sloping AD for our aggregate demand. Okay, so if I was to increase, I would draw a new line. Okay, I'm going from AD to AD1, and I've got my arrows. All right, do not forget, okay, make sure on the AP exam, whenever you're showing a shift or you're showing an increase or a decrease, that you're always putting arrows. You have to show directional change. Okay, so on slide 6, we've got an example of an increase. On slide 7, we would do the opposite to show a decrease. Okay, so with the decrease, we would draw our shift then going to the left. Okay, so AD going to AD1 to the left. I've got my arrows. We're good to go. Slide 8, I have got the 4 determinants of aggregate demand. And again, the determinants of aggregate demand are the same determinants that affect GDP. All right, so if you did not get that written down earlier, go ahead and add that to your notes. All right, the 4 factors that affect aggregate demand are the same 4 factors that affect GDP. So consumer spending, investments, government spending, and our net exports. I'm going to go through and give you sort of an example on the next 4 slides. What consumer spending looks like, what factors affect it, and so on and so forth for the others. But one thing I want you to know, on the AP exam, they're only going to throw one of these variables at you at a time. Okay? So, for example, I'm not going to give you a question. It'll be like, consumer spending goes up by 308 billion and investments go down by 140 billion and so on and so forth. It'll just be consumer spending rises or consumer spending falls, but really the big one we're going to focus on will be government spending. Okay? But consumer spending, basically our ability to spend is affected by things like our wealth, our expectations, how much debt we have, and the taxes that bestow upon us. So really with these, it's a lot of this is pretty intuitive. I've got this in here just to help you out and give you something you can quickly go through in addition to your textbook. But the more money we have, the more money we're going to spend. When you get a high-paying job, you're going to spend more money than when you're broke, living paycheck to paycheck, and so on and so forth. As far as expectations go, if you know you've got a big bonus check coming from your job, you're probably going to be more likely to spend more money. That's a micro example, but we're going to look at this on a macro example. So, think about it as the entirety of the U.S. population. If we collectively have good expectations about what the future is going to bring, then we're going to go out and spend more money. A good example of this would be, buying high-end items. Consumers are more likely to go out and buy things whenever we feel like the economy is doing well. So, if you see Target and Walmart and all these other, major corporations posting an increase in sales, we probably have pretty positive expectations. On the other side, if we start curbing our purchasing, then that usually can be an indication that the economy might be weaker and, we might need to take some action to prevent a recession from occurring. Now, debt will affect our ability to spend because the more debt that we have, the less we're spending on consumer goods. All right. Whenever you make a payment to a debt agency, all right, that won't count towards GDP. And I know we didn't cover this before, but let's take a step back and let's think about this for a second. Whenever you use the credit card initially, right, you're taking that money that you don't have, you're borrowing it from this lender, and that money is being spent as your consumption at that time. Whenever you are, paying that card back, you're paying them back for the service which was bestowed before. And we don't count that because that's going to end up leading to double counting. Now, we could go, in a more advanced finance class, we'd go into, the finance fees and all of that. But for this course, you just need to kind of understand the less debt we have, the more money we're going to spend on fun things. The more debt we have, the less we're going to spend. The less debt, the more we're going to spend. Okay? And then taxes. All right, taxes are a big thing. If the government decided that they wanted to raise taxes across the board, well, more taxes means that we're going to have less spending. Our money goes to the government. We'd have a lower level of disposable income. Okay, our take-home pay would be less. But if the government said, you know what, we're going to lower your taxes, well, now we've got more money, and consequently, we're going to spend more as well. When it comes to investments, really the key to understanding investments, if you want to leave yourself a note there on slide 10, the key to understanding this, it's all about interest rates. Okay, it's all about interest rates. And so what I mean by that is domestically, the lower the interest rate is, the more businesses are going to want to invest. Okay, so we talked about it before with GDP that whenever you think of IG or our gross private business investment, think in terms of physical capital. And when you're thinking of investables for a company, a lot of times when businesses need to make big decisions, they do so by borrowing money. If I'm a company and let's say I'm Nike and I've got a new order of shoes coming out, but I don't have enough actual cash on hand to pay for the receivables, to pay for the goods or the resources I need to make the goods to sell, I'll go to the bank and I'll take out a loan and I'll borrow that money, pay for the cost of making my stuff, and then ultimately when I get my profit from selling my shoes, pay back the bank in return. All right. Now, I'm going to be more likely to borrow money from the bank when there's a low interest rate. I'll invest more. Sure, no problem. I don't mind paying because the cost of borrowing is so low. Now, when that interest rate goes up, it's more expensive for me, and I'm going to be less inclined to want to spend or want to borrow money. It also comes down to our expected returns. If I think that I'm going to get a good return on it, it's that saying, more bang for your buck. I got to look at the long run ramifications. And so this goes back, we talked about this in Unit 1, marginal cost versus marginal benefit. So that's what a business is doing here. They're looking at the cost of doing said investment. They get a good return off of it. Great, let's go ahead and do it. And a lot of times that return might be the fact that interest rates are so low. Okay, it could also be the fact that it's just a really good opportunity. The market's in a good spot. And so, expected returns, looking at future profitability, looking at technology, looking at excess capacity. And so that's looking at our existing stock of capital or how much we're working with at the time. It's also affected by business taxes. If we raise taxes on businesses, and this is oftentimes something that you'll hear in political discussions, between, candidates during election times. If we raise taxes on businesses too much, too fast, well, now businesses are going to have less money that they can use to hire workers. And what we're going to see in the next part when we look at aggregate supply is that could actually affect a business's ability to hire workers. They might have to end up cutting back on labor or cutting hours. Government spending, we talked about this before. If the government spends more money, it's going to go up. If they spend less money, it's going to go down. In our country, 67% of our economic spending comes from consumers. And so, it's a lesser component, but for this course, especially when we start looking at fiscal policy in Unit 4, and fiscal policy is where the government tries to manipulate the economy to fix it and keep us at a good equilibrium point. They do so by changing, taxes and government spending. I've got a little note there for you just to keep in mind. Transfer payments do not count towards GDP. Okay, so any form of Social Security, welfare, and that includes things like CHIP, Medicare, Medicaid, food stamps, financial aid for college students, so on and so forth. All right. Last one is net exports. Okay, and I really want you to link net exports back to when we talked about foreign exchange. It's all about exchange rates. We saw before that anytime E goes up, and we talked about little e being the exchange rate or the price of a dollar. When E goes up, we'd have a stronger dollar. And if we have a stronger dollar, other countries are less inclined to buy our goods, right? So what's going to end up happening is we have a strong dollar, meaning our prices are higher here. We've got maybe a little bit of inflation going on. So we're going to import more from other countries and probably sell less of our stuff to them. Now versus when we have a weak dollar, and that exchange rate goes down, and it could be that the demand for the dollar goes down. Well, in time that could lead to us importing fewer goods from other countries and ultimately selling more. Okay, and so it's all about relative income. Strong foreign economies means more exports, AD goes up. Weak foreign economies, less exports, AD goes down. And when I say weak and strong foreign economies, I mean, of course, relative to our U.S. dollar. Okay, if other economies' dollars or currencies are stronger than our U.S. dollar is, relatively speaking, they're going to sell more of their stuff to us. We're going to sell more of our stuff to them. On the other side, if their currency is weaker than ours, then they're going to buy less of our goods. We're going to export less to them. Okay? So I threw on here a summary slide just because I know this is sort of a lot and I'm going through quickly and I'm not there to ask questions in person. But AD reflects an inverse relationship between price level and real GDP. In other words, whenever the real price levels for the economy are up higher, there's going to be less total demand for final goods and services. Changes in prices create different reasons why we have this downward slope. We've got 4 determinants that affect aggregate demand: consumer spending, investments, government spending, and our net exports. And of course, always remember, increase always to the right, decrease always to the left. Okay, so now we're going to talk about Module 18. Okay, Module 18, this is all about aggregate supply. And we're going to break down aggregate supply into 2 different categories as we go through this. We're going to look at aggregate supply both in the short run as well as in the long run. Okay, so looking at slide 15, aggregate supply is the level of real GDP that firms will produce at each possible price level. Okay, so just a real quick recap and reminder, when we're talking about this word firms right here, okay, firm is another fancy word for a business. It's also a fancy word for a producer. So firms, businesses, producers, we're talking about the same thing. Okay, but when we're talking aggregate supply, I want you to think suppliers on a national scale. Okay, so we're not talking about just Walmart or not just talking about Target. We're talking about the collective of all businesses within our country. Or in other words, how much output will all those businesses in the country collectively make? All right, so when we're looking at long run versus short run, what I want you to kind of keep in mind is that these terms long run and short run are kind of arbitrary. There's no set length of time between how long is the long run and how long is the short run. You can leave yourself a note on the side of your slide if you want to. Short run, it's typically someplace, 6 months to a few years, okay? But don't really take that and go anywhere with it because, like I was starting to say, it's very flexible in terms of how long it could be. Okay, but we differentiate between the long run and short run because the long run is kind of like the picture perfect ideal of where we're eventually going to go, and the short run would be the in-between points along the way. And I guess the easy way you could think about it, and it'll make more sense in a moment when we see the graph, but if you've ever seen one of those big grandfather clocks before, the ones where the pendulum will swing back and forth, tick tock, that middle point when it crosses across, or when it comes across the middle, that is long run, okay? It's the middle point, it's the picture perfect point where we want to be. And the short run would be the swinging and back of the pendulum. And what we'll be able to see when we look at this is, different effects of the business cycle. In that long run point, we are at full employment. We are exactly where we want to be. Versus in the short run, we might have inflation, we might have a recession, we've got some sort of situation going on that's not completely ideal. Okay? So kind of sort of keeping that in mind, the long run is a period of time where input prices are completely flexible and adjust to changes in the price level. Meaning that we're going to see that prices could be higher and lower in the long run than they were in previous years. Because it's going to, like what we're going to see momentarily, is it's all about long run output, or it's all about full employment output. Okay, so real GDP is independent of the price level, meaning that in the the long run today is different than the long run was 20 years ago or 20 years before that, so on and so forth. The economy's become more robust over time. It's bigger, Prices, we can conclude though, however, have changed. Now we compare that to the short run, and this is where we would say a period of time in which prices are sticky and do not adjust to changes in the price level. So input prices being sticky, meaning that those costs are not going to really change too much right now. Input prices being the cost of our raw materials. If I work in the dairy, industry, and I make cheese, the cost of the products I need to make more cheese are going to be relatively consistent today, as they will next week, as they probably will within the next 6 months, or the foreseeable future. I can't guarantee that way far off in the future, but at least in the short run, it's going to end up being pretty constant. And so that's what I meant by there's no set length of time. It's usually 6 months to a couple of years, but it's very different in each industry. All right. And in the short run, the level of real GDP supplied is directly related to the price level. So we'll see that in a moment as well. Now, the long run aggregate supply, we're going to look at this one first. It marks the level of full employment with the economy. All right. And I put down a note for y'all. This is analogous to the production possibilities curve that we talked about before. In other words, if we are operating at a long run point, we would be operating someplace on our PPC curve. And so because input prices are completely flexible in the long run, changes in the price level do not change businesses' real profits, and so it's not going to change output. So what we're going to see on slide 18 is that long run aggregate supply is actually going to be a straight up and down vertical line. Okay? And what I want y'all to kind of understand by that is you can see right here that price level is independent. If we look at, let's say that down here, this could represent a point. If we were to, draw the dot on there, that could be a point. And let's just throw out a random number. Let's say that was the level of prices in 1950. And we could also put a new line up here and say that this was the set of where prices were in 2016. Now, my two lines don't really mean anything because we have no real, way of identifying. We don't have any numbers over here on the y-axis to mark it, but we've gone through enough math that we can conclude that 2016 is set at a higher price level than 1950, which of course makes sense with what we already know, that prices have gone up over time. Now, what we see though is, if this is where full employment is YF, and we said before that YF is the same thing as the NRU, which we said we also might see as U subscript N, which is equal to 4 to 5%. All right, 4 to 5%. And so as long as we're at full employment, we're operating someplace on that line. Okay? So that right there, that is how the long run aggregate supply works. It's a straight up and down vertical line. Now, that is the picture perfect dream world where we'd like to be. Okay? But because input prices are sticky in the short run, SRAS is upward sloping, SRAS being the short run aggregate supply. So what this shows us is that in the short run, increases in the price level will increase businesses' profits and actually give them an incentive to want to make more. Businesses, we said before, go into business to make money, and if I can go into business and make more money, heck yeah, I'm gonna sell more stuff. Now, as price levels fall, firms' profits will drop, which is going to make the incentive actually for them to make less. Because if they start making less, that's going to end up making prices go up. So we end up having essentially a collective collaboration to create shortages along the way. And what we're going to end up seeing in this class is that almost every time we shift something on a graph, it's going to be SRAS. Very rarely will we have to move our long run aggregate supply, and the only way we'd really do that would be some sort of change that makes our production possibilities curve move. So that would be a change in our resources and or our technology. Okay, so here we have on slide 20, we have our short run aggregate supply curve. And what we can see right here is this upward sloping line. And so what we're seeing is that, a positive slope. As price level goes up, so does my incentive to increase my GDP. All right, so higher prices means I make more stuff, means that the economy is bigger and better than it was before. All right, so we do have changes in SRAS, and what's nice is that there are very few variables that we're going to look at, and we'll look at those in just a moment, but an increase, just like with regular supply, increase goes to the right, decrease goes to the left. And so the biggest thing to understand is all about per unit cost of production. And the way we can figure this out is we look at the total input cost divided by the total output. And so, you might hear, if you ever watch shows like Shark Tank, they'll want to figure out, how much does it cost you to make the product and how much can you sell it for? Well, that production cost is important because the cheaper that a business can make something, the more profit that they stand to end up making as a result. It's like when you go to, let's say you go to HEB and you want to buy a bag of chips on the way out, and they've got those Frito-Lay 99-cent bag of chips there. And you go up and you say, okay, I want to buy that chip. So you buy that bag of chips and you go home. Well, let's say that Frito-Lay's cost of making that 99-cent bag of chips is probably someplace around 7 or 8 cents, okay? Because they're making in such large quantities. Now, I'm making these numbers up, but let's say it's about 8 cents. Now, imagine that there's some sort of supply shock. Shock being something that happens to the marketplace we weren't expecting. And let's say that the cost of production ramped up, and instead of it costing them, 7 or 8 cents to make it, now it costs them 27 or 28 cents to make it. Is Frito-Lay going to say, oh, well, you know what? I don't mind. We're already making a whole bunch of money. We'll keep it at 99 cents. No, Frito-Lay is going to come out and they're going to raise the price. That's why you end up seeing, McDonald's and other fast food establishments no longer having dollar menus. They have extra value menus. Okay, so as the cost goes up, so does our cost as consumers. So 22 and 23, we're just going to real quickly go through what changes, both increases and decreases look like. So increase, okay, we're going to draw it going to the right. Decrease on slide 23, we're going to draw it going to the left. Okay, and we've got 3 determinants for short-run aggregate supply. Okay, our input prices, the cost of our raw resources, our productivity, how hard we're working, and legal institutional environment. You'd abbreviate as LIE or LIE for short, which works great because it's all stuff that comes from the government. So if you got a chuckle out of that, awesome. If not, it's okay. I know that you're used to my corny jokes. All right, slide 25 looks at input prices. And with input prices, wages are a huge component of business cost. We're looking at domestically, so paying our workers, the physical capital that we need. It also includes our human capital, the training that we give our workers to make them better at their jobs. It looks at our foreign resource prices. We buy things from other countries, and so a stronger dollar means that we could buy their raw inputs for cheaper. A weaker dollar means that we're going to be less inclined to want to buy their stuff. But really the big important thing to know is that if the cost of resources goes up, supply is going to go down in the short run. Okay, businesses are going to take a hit, and it's going to result in higher prices. Back when the recession hit, an example I usually use with my students each year is there was a guitar that I was looking at buying, and the guitar was a $1,200 Fender guitar. And almost overnight, the cost of that guitar went up to $1,600. And what had happened was, in making that particular model, Fender used mahogany wood that they had imported from China. And so when the cost of manufacturing and shipping goods went up, Fender, had higher costs to bring that wood from China over to the mainland U.S. where they manufacture that particular model. And so as a result, there was a $400 surcharge. Literally, there was no difference in the quality or the build. It was just their cost went up, therefore our costs went up. All right, now if there's a decrease in resource prices, then of course our supply will increase collectively. Productivity is extremely straightforward. I'm going to go through this one real fast. The more productive our laborers are in our nation, the more we're going to end up having of supply. Less productive, less supply. All right, and our last determinant we're going to explore is our legal institutional environment. And basically, this is all about taxes, subsidies, and regulations. when business taxes go up, all right, when business taxes go up, supply will go down in the short run. And the symbol for business taxes in economics is BT, both capitalized. All right, so if BT goes up, therefore we would be able to conclude SRES would go down. Okay, so higher business taxes means less supply, lower taxes, more supply. We talked about subsidies before. Subsidies are monies that come from the government to businesses to produce more goods. More subsidies, more goods. Regulations. Regulations hinder a company's ability to produce goods. Less regulations means we can make more goods. So in summary, aggregate supply is looking at the level of real GDP that firms will make at each price level. Short run explores it in the, relatively speaking, shorter period of time. There's no set amount of length of, short run versus long run, but typically someplace 6 months to a couple of years for most industries. And understanding shifts in SRES, understand it's all about per unit cost of production. If it becomes more expensive for whatever reason to make a good, they're going to make less of that good. If it becomes cheaper, then they'll make more. Okay, I'm sure by this point you're probably at saturation point. We're almost there. Hang in there. I want to real quickly kind of give you an overview of what this is going to look like when we throw it all together. I gave you AD by itself. I gave you the long run aggregate supply curve by itself. And I gave you the short run aggregate supply curve by itself. What I'm going to do now is give you the entire graph together. Okay, so on slide 30, you've got all of this together. And when you're looking at this, okay, I want you to notice something, and that's that we've got right here in the middle, we could kind of put a dot there, all right? This right here would be what we would call long run equilibrium output, meaning we are operating at 100% efficiency, meaning we're someplace 4 to 5% unemployment, consumers are buying a plethora of goods and services, businesses are productive, they're doing everything right, okay? And this is showing us the equilibrium of aggregate demand and our aggregate supply. And it really helps us determine the size of GDP within the economy, as well as the current price level for the aggregate economy. All right. So like I said before, so we're looking at full employment whenever we look right here. Full employment being SRES, AD, and LRES all coming at the same point. One thing I have my students do, and we'll do this in class, is when we're drawing on the desks, I want you to get in the habit of putting, the dot on your paper, okay? I want you to get used to. So go ahead right now, and I want you to put a dot right there, okay, where that intersects. That way, this is not art class, but if you ever draw and your art skills aren't the best and you make a mistake, it will show that, okay, hey, grader, this is where I was trying to put my equilibrium point. So it helps you see it, but it also helps in case you make a mistake along the way. Okay? And then we've got two different types of gaps. We've got a recessionary gap, and we've got an inflationary gap. The first type of gap is a recessionary gap, and this exists whenever equilibrium occurs below full employment output. Easiest way I've got my students when it comes to drawing these, and I'll go ahead and draw this on the side. I won't put all the labels because you've got the labels there, but just to kind of show you, the way that I have my kids do this to remember is go ahead and draw your X first. Your X for your upward sloping short run aggregate supply, your downward sloping aggregate demand, and then I always put my long run in afterwards. Easiest way, and you might write this on the side of slide 32, think our recession, we're going to draw our long run line to the right of where our current equilibrium is. Okay, and what that means, it's not saying that necessarily that our long run aggregate supply has moved, because it hasn't moved. What has moved is where our current equilibrium, which is our AD and SRAS, where they intersect with one another. Okay, so usually in a recessionary gap, this is because either businesses cut back on production, or we collectively as consumers, as businesses, as the government, spent less money. So if we collectively spend less money or produce less goods, we'll most likely find ourselves in one of these recessionary gaps. Okay? So again, R recession, R we're drawing the long run to the right. Okay? Now the inflationary gap, think I inflation, I draw that long run line inward from where the line is. Okay? So you might go through here and you might practice this on the side of your slide again. Go through, draw your X. Okay, so you can sit there and look at, upward sloping SRES, downward sloping AD, and I'm going to draw my inflationary gap, draw that line inward from where I was. Okay? And so this next slide is going to look like a whole lot of information to you. So basically, this is getting you ready for statements. Okay? There are going to be statements with this, and I'm giving you, this slide is sort of a cheat sheet of every single way in which you're going to see statements on the AP exam. Now, I know I've got 8 different statements, but I would honestly just go through and look at the top lines. All right? And even more so from that, and I'll try to separate this as much as I can. All right? If I draw a line right here, I want you to see everything that's over on this side is the exact same for each of these. Okay? So, for example, if I'm looking at consumer spending, what this is telling me is that if consumers collectively in our country spend more money, therefore, aggregate demand or total demand for the economy will increase or shift to the right. This will therefore cause the amount of real output within the economy to rise and the cumulative price levels to rise as well. Therefore, ultimately, we could conclude that because of a stronger, bigger economy, more GDP, that unemployment rate would go down, and because of higher prices, we could conclude that the inflation rate went up. All right? Or C up, therefore AD up, therefore GDPR up, PL up, therefore U percent down, pi percent up. And one other thing I want you to see is that GDP, or really, let's start all the way over. C, AD, GDP, PL, and inflation all are moving in the same direction. Okay? They're all moving in the same direction. The only one that's moving opposite there, or inverse, is the unemployment rate. And this makes sense if you think about it. Unemployment has an inverse relationship with output. So when the economy is bigger and doing better, we're going to have less unemployment. Now, if you look at the second bullet, when consumption goes down, well, now we've got less AD. We're probably moving towards possibly a recessionary gap, although not necessarily. But less spending means less total demand, less GDP, less prices, less inflation, but we're going to have more unemployment than what we had before. And as you can see, I'm just substituting C for IG, G, and XN. So it's going to follow the exact same format. So it looks like a lot, but it's really not so bad. All right, so slide 35 shows us what this will look like. So on slide 35, you can see we're currently having a recessionary gap. And so we want to get out of that. And so by an increase in aggregate demand, it could be a change in consumer spending. Maybe we're spending more money. Maybe the government spends more money. Maybe businesses are investing more. Or maybe our trade deficit has now become a trade surplus. Well, we're going to draw a shift going to the right. And I want you to notice something. I drew my shift intersecting at long run. Okay? So whenever I drew this new line, I had this line come all the way here and made everything connect back together. And the reason for that is we're going to assume that all changes are enough to fix the economy and get it where we need to be. Okay? So we're always going to do a change. If it's moving in the direction of long run, we're always going to do a change that gets us to that long run point. Okay, so I do my shift and then I would do my statement. Whatever that determining factor was, therefore AD would go up, therefore real GDP and price level would go up, therefore unemployment would go down and inflation would go up. Okay, so when we look at a decrease in AD, we're going to do the opposite. So maybe AD goes down because we were fighting some inflation, so maybe the government cut back on their spending, in a form of fiscal policy, and so here we'd have aggregate demand going down, lowering the price level. So by lowering the price levels, we got rid of the inflation that we had in the economy. Okay, so changes in SRES, looking at our 3 factors: input prices, productivity, and our legal institutional environment. All right, let's say we're in a recession and businesses start getting more productive, or we're in a recession and the government decides to cut taxes on them. Well, hey, one of those factors happens and SRAS will increase, it'll shift to the right. Now, remember, just like when we did regular supply and demand, SRAS 1 looks like it's below the original SRAS. That's why we don't think in terms of, supply went up or supply went down, but rather supply went to the right, because as we move to the right along the number line, our numbers get bigger. Okay, but here what we're going to see is that when SRAS goes up, GDP goes up, but more supply means less prices. Okay, so when supply goes up, we're going to continue that same inverse relationship with price we had before. So more GDP, less prices, less unemployment, and less inflation. Now, let's say we're operating at full employment. We're right where we wanted to be. This is slide 39. But, let's say that we had a supply shock and the cost of raw resources goes up. Well, if the cost of our raw resources goes up, well, that's going to make our short-run aggregate supply decrease or shift to the left. So now we're going to end up with less supply, less GDP, higher prices, which means higher unemployment and higher inflation. So write down a note for yourself on slide 39. We have here, right here, stagflation. Okay, so a decrease in SRAS, slide 39, a decrease in SRAS can and will lead to stagflation. Okay, so in summary, we've got a change in consumer spending, investments, government spending, and or net exports will be a change in AD. All right, right below that I've got an example of increases and decreases in AD. A change in input prices, productivity, or regulation will be a change in our short-run aggregate supply. All right, and again, an example of what the statements look like. The ADAS model is the most important graph in AP macroeconomics. You have to know this graph. We're going to work on this graph a lot in here. So just practice, practice, practice. And, again, if you have any questions, shoot me an email. Hopefully, if you have not started thinking about it yet, you need to start thinking about your Unit 3 Part 1 exam. It will be due by 4:15 on Friday. There are no exceptions with it. Okay? So, we talked about it last week. You're getting the reminders in class with the sub. It's on the board. Please do not forget. Okay? That's all I got. If you got any questions, shoot me an email, and I will see you all when I return. Thanks. Bye.